Yeah, we had quite a week last week from events around the world. So let me just jump into it because there was a lot going on. We had the Trump verdict, important inflation readings for the Fed. That's their PC's their favorite reading. You have Eurozone inflation in the ECB ready to make a cut. China's PMIs, which were important as to where their growth is, and then really overall how AI is weighing on the markets and the overall economic outlook. So let's talk about the politics first. The Trump trial is pretty representative of just how crazy the world is today. One of the leading analysts we follow on Washington, D.C. and policy and shared his thoughts with me as follows. What happened last week will undermine the legitimacy of the election, regardless of who wins, that we are going to have both sides saying that the politics of the trial and other things are calling into question how both parties are playing today. It also begs the question, where do we stand as a nation on the rule of law? One of the more fundamental aspects of our system here. It also begs the question, what are the parties' platforms going to be going forward? When you think about what's gone on lately, some of the changes that President Biden's been making look a lot like what some of the stuff Trump's talked about, whether it's tariffs or focusing on the border, things like that. So I think there's still big differences, but they're really both going for what they think is the populist approach. So hard to know what the real foundation is of either party's platform these days, because they're not what we used to remember them as. And then the big question is, how does it play out in November? And a couple of weeks ago, I mentioned that in the battleground states, a survey by Gallup suggested that a Trump conviction would be positive for him in terms of votes. And I think the early results say that that's probably right. So a lot more to come in this. It just speaks to what an insane political world we're living in today. So let's get off of there, or U.S. politics, because it's not one of my favorite areas, and get to the Fed and inflation, which is really on people's minds these days. And we had a pretty decent PCE reading of 2.7% year over year last week. While it shows that inflation's not being as tame as the Fed would like, it directionally is moving where the Fed wants it to go. It's just at a slow pace towards 2%. As a result of this and other inflationary forces, the market's now pricing in 38 basis points of cuts by the Fed this year. As of last Friday, I didn't check it the last 2 days, but as of Friday, it was 38 basis points of cuts, versus at the beginning of the year, we were looking at 7 cuts of 25 basis points each. So market expectations have come down a lot. And I think that's because the Fed's really in a risk management mode. And everyone's getting a lot of criticism for being, too late or too early, or should they move faster and all that. The Fed really wants to see the trend continue downward. And I think that the debate that they're struggling with is there's two sides that they're really dealing with. Is you have the deflationary forces that are at work today of AI and the labor supply, which labor supply short-term has been augmented by immigration, both legal and illegal in the United States. So those are positives. I don't expect the illegal immigration or the immigration policies to have that be a supportive tailwind for deflation going forward. Unfortunately, on the other side, you have real structural issues that are coming down the pike. So whether it's de-risking or deglobalization, you've gone from working towards the most efficient global process for commerce to one that is not as efficient, which is inflationary. You have an energy transition, which, Mark, when we first really talked in London about giving a briefing similar to this, you raised the question, is the climate transition inflationary or deflationary? And I said initially it's inflationary. I didn't expect 4 years later we would still be talking about it initially, but I think we are still in the early stages of the energy transition. And as a result, we are seeing the inflationary pressures that come with that.
That, Stephen, was what catalyzed these briefings. that London conference.
And then we have the $4 trillion of fiscal stimulus that the U.S. has thrown in, which the Fed really can't do anything about that stimulus coming in and the impact on inflation for that, because it's beyond their purview, and cutting rates doesn't change the fact that $4 trillion or more is flowing into the system over the next 5 years, so to 7 years. So that's an inflationary force that their rate setting won't change. And then you add to it that there's growing talk of tariffs, and tariffs are inflationary. They will increase the cost of goods coming and going around the system. So we're still back to this kind of the Fed's driving with one foot on their brake, where they're trying to slow things down, and that fiscal policy and these other policies are creating an accelerator for inflation that's really a problem for them to navigate. So I think we're going to be in this mode where for a bit of time where the market will be very reactionary to in short-term inflationary readings. And I would just step back and think about really where we're going longer term. As I said, the market's not pricing in big cuts. This is as of December, and this is the market's view of where the probabilities would be for Fed funds at that point. And really the bulk of them are around 475 to 525 is almost 72% of 74% of the expectations are in that range. So not a lot of cuts there. And you have the outliers who are saying it's going to be a lot more cuts or no cuts. It's too soon to tell, but I think that the Fed is appropriately cautious right now because of what's out there in the system, and are looking at it really the right way. So let's shift gears to the Eurozone, where you're starting to see some issues there with the inflationary numbers that they're showing, and they have some structural issues there as well. So inflation on their number is the blue line, the harmonized index, of consumer prices is around 2.7% as well. But they're going to go ahead and make their cuts. I think they're going to start because I think they need to. I think they'll see some more inflationary pressures coming in, but they're primed to cut at the next meeting. They are seeing the trend, but they are not having the growth problem that the US is having. So the Fed has strong growth and full employment. Europe doesn't have that growth, so a cut right now is probably more appropriate for them. Unfortunately, what that will do is create some other divergences, including a stronger dollar. So I think we're in a mode where the expectations for the ECB in terms of cuts was 7 in April. It's now 6. I'm not sure they'll get to that many cuts because I think inflationary pressures are going to pick up in Europe. I think they have some real challenges that they're facing, which is why I say that. So asked about the top risk for the Eurozone, the Bloomberg survey of economists says that their problems are similar to the US problems, inflation. And I really think it's not as much inflation as cost of living. Again, people keep confusing that, but when asked the question, that is really the way people think about it. Obviously, the US elections are weighing on sentiment because of the divergences of policies of what the outcomes could be. If it's a Biden win or a Trump win are pretty high. The other thing is if it's a Trump win, you get the factor of the unexpected that you have to deal with as well. But I think these are the issues that are weighing on people's minds right now. But I think in Europe, their top risks are really where the growth is going to come from going forward. Because I think while Europe's doing better now, and I've been talking for the last probably month or so about, I think Europe and China are in a bottoming mode. I think the structural issues are still exist for Europe, and they're deep structural challenges. You have an aging population and a system that relies on very heavy subsidies in terms of benefits for their populations. So you need to have a growing labor force. And when you have an aging system with low fertility rates, that creates a very negative longer-term structural headwind. Climate change, while Europe's on the leading edge of that in terms of the green transition, the problems they're facing with the old economy energy is still real and still there. And then you have global fragmentation coming into play And as one IMF heads described it, he said, while Europe is better now, the deep structural challenges await. Weak productivity and with it, poor potential growth is one such problem. And the IMF is targeting, they're targeting pretty good growth for Europe this year. But one of the things that they're highlighting for Europe, good growth relative to where they've been, one of the things that they're highlighting for Europe is that they're lagging the US in potential GDP growth by 18% since 2000 to now. So their productivity, their potential for GDP, they're 18% under what the US potential was. And by 2050, they're expecting that could get as high as 50%. So there's some real structural issues that they have to get through in Europe that I think is going to put more focus on getting a better fiscal union to match the monetary union, which is going to be a problem given the politics that exist today and all the elections that are going on. So I think there's good short-term opportunities in Europe with a need to face up to some real structural issues that'll take some time to get through. Switching gears to China, the IMF raised their growth projections for China for this year, mainly around two things: good first Q1 growth, and then the stimulus that they were putting through. But you also have some other issues with China too. So when they're looking at their forecast, they said they raised it for this year and next by 0.4%. So you're looking at 5% this year, 4.5% next year, but dropping to 3.3% growth in 2029. And that's because, again, aging population and slower productivity growth are going to weigh on their system. So this is a challenge for what happens next in big parts of the global economy, with Europe and China looking at slowing structural issues. And the US has some of those same structural issues that exist. I think one of the big challenges for China is really navigating how do you maintain your export markets with the US and China while you're trying to compete with them. And at the same time, how do they get their economy to be much more balanced? And I think the big issue for China isn't their manufacturing and isn't the dumping that's coming. And that is a big concern for the West. It's probably the biggest concern for the German economy in terms of the concerns about dumping by autos and the like by China. But I think the real issue is going to be how do they navigate that and at the same time get their consumer to create the balancing of the economy that they need so that they can be more domestically oriented, at the same time being a player in the global stage and having a better mix of business. So I think China's facing some real structural issues there. And you're starting to see it in some areas where all of a sudden they had factory activity contract and then it's rising again. It's bouncing all around. And I think this is really a sign of the near-term volatility and the short-term orientation that the markets have today around what's going on. But you can see why there's tension in the exports that China has and why the imbalance of their system is creating problems around the world, and how do we get that straightened out. And what's further complicating that for China is the fact that property was such a big part of their domestic economy, and that's weighing on their consumers so much that it creates this slower growth problem. I do think China's taking the steps to resolve some of this, but it really is a big challenge around the world that you have these macro headwinds. And when you think about some of the divergences that are going on with rate cuts in Europe, some more stimulus in China, weakening of currencies against the dollar, that puts more pressure on the global system. It actually reduces the inflationary pressures of the imports into the US, but it creates greater strains on the global system. So I think this puts us in a really funny spot, which I'm giving you a lot of stuff that says this is why it's such a complicated environment. And while everyone's saying it's easy for the Fed and the central banks to make their decisions, or for government leaders to make their decisions, this is one of the most complicated environments I think we've been in some time. And we didn't even talk about all the conflicts yet that are going on around the world and the impact of those. And then you add to it all these problems, and you look at borrowing costs are at the highest they've been in quite some time. And when you think about it, for most of this period, we've had rates going one way down, and we're coming to the end of that period, and now we're adjusting back to normal interest rates, not high interest rates, but normal interest rates to where we've been historically. So I think this is one of the things that we're struggling to get our minds around. And I think the market is hoping that the Fed will continue to bail them out with a put, and that central banks will allow them to get the P multiples expanding, because they're not really seeing it in revenue growth. And what's interesting about these borrowing costs are they're starting to weigh on areas that are leading to discounting from Target and Walmart and the fast food companies, because you have wages going up a lot on one hand, and that's been pushed through from the inflationary pressures we've had. And yet companies will not have struggled to maintain pricing. If they have to start moving to discounts, that's going to hit their earnings. So it creates this have and have nots in the corporate side, similar to what we're seeing in the consumer side. So the monetary policies are starting to diverge, and that's going to create new problems, particularly around currencies. And it's also going to create new problems around the tariff issues that are going to come. So I think you're going to start to see some levels of protectionism and other tit-for-tat battles going on there. I think we are seeing some positive signs in the near term from Europe and China that will complement the strength that the US economy is having, but we are seeing some slowing in the US too. The Atlanta Fed's GDP now number came down from, I think, 2.7% last week to 1.9% this week. So in a week, they've seen an 0.8% slowing, I believe. It might be 0.5% slowing, but definitely slowing in the US. And what does that mean for the global system? I think we're now at a point where the global conflicts are entering a new phase, and it's not necessarily a good one. What you're seeing in the Middle East with Gaza and where we are there. Israel just took out another Iranian general in I forget which country, but not in Iran. But will that lead to another 300 missiles being fired back? I don't know. But how the peace plan or peace talks that they're working on play out, that looks like a challenge for both sides as well. And then you have tensions in Ukraine really starting to ratchet up. So I think there's plenty of challenges in the global conflict area. And I did hear today that the President Marcos of the Philippines has said that if one Filipino soldier is killed by provocations, that would constitute a war. So you're starting to see things really heat up in the global conflict area as well. Whether that is election posturing or not, I don't know, but I think it's something we have to be conscious of. You have the upcoming elections, which are weighing on everybody, particularly the U.S. election. And interestingly, the concerns of China and other adversaries of a Trump administration are higher than they are for Biden, because of the unpredictability of President Trump and the fears that his new administration, if he got in, would bring people who would be less old school and more willing to go along with whatever he thinks is legal to do, and that might push us beyond the norm there. So I think those are real issues. The other one is debt servicing. It's growing at a pretty alarming rate, and that's whether it's households, companies, or countries is going to choke off necessary investments in other areas and create bigger divergences in the haves and have-nots. And then I think the tariff thing is going to become a much bigger issue as we move forward. So energy, industrials, materials still remain standout areas because they're supported by four big things: reindustrialization, global fragmentation, climate transition, and generative AI. And under the global fragmentation, I would throw in national security issues. So for me in this environment, you really want strong balance sheets and free cash flow. And while the FANGs were being written off earlier in the year, I think what you're seeing now is their ability to self-fund and to make the investments or to cut investments in areas that they don't want to spend, or giving them the ability to navigate this environment better than others. So it's one of those interesting areas where I think the rich are going to continue to get richer. And that may be part of the reason why you're starting to see a lot more the supporter from Wall Street and from Silicon Valley shifting towards President Trump, because they feel that his policies may be more supportive of their interests. I would also say that the other concern of a Trump administration is the independence of the Fed. And that is something that I think everyone should be concerned about. If the Fed loses its independence, that is not a good thing for the system. So, Mark, a lot to cover, a lot to discuss. So I'm going to stop sharing and we can open it up for conversation.
So Wanda has her hand up, but I did want to talk about the Mexican election and what that meant for an independence of the judiciary. But let's pause on that. Wanda.
Just on that, Mark, the numbers for Mexico, I saw a fascinating statistic that the violence in Mexico for around this election had 500 killings of political killings as a result in this election cycle. And there were 34 candidates for local or state office killed in the last 9 months in Mexico. So I don't know how you would describe that environment as you think about that going forward. And they're killing it economically right now. So, crazy.
We might have to do a Mexico deep dive. Wanda, to you.
So my question, number one, was about Mexico and going beyond killings. What will be the effect of this new old government and China expanding or bypassing the tariffs to the US? Do you see any particular impact on that? What I mean by that is China is building their EV factories in Mexico and so on. And on international front, we also have partial results for India. How that will impact our investment climate? Thank you.
So Mexico, I think it's going to be more of the same from the government there, because it's basically the same government. I think if AMLO could have, he would have reelected himself, but he couldn't. So I guess she's going to continue what he's doing. I think they're doing well economically because of nearshoring and friendshoring, and I think China always figures out a way to get their goods in through other countries. So I don't think that's really a big shift in how they've operated. So I don't see that as a big change. I think the India election is interesting, with a big change in the last 24 hours, where it looked like he was going to win with a big majority, and now it looks like he's going to have to form some kind of coalition government, although it's a little early to tell. And I'd ask some of the folks from that area if they want to weigh in on their view. But I do think that they will continue to push through the policies he's had that will help them continue to grow. I did read today that I think they're going to really, in this next term, put a big focus on infrastructure, which is a necessary thing for them to realize the potential. It's a question of how much money can they put to it, and can they get it done in a way that they can seize the opportunity. But this is what everyone's been waiting for. Do they catch the brass ring this time or not? Hard to say, but he's got them in the right direction. It's a question of can they execute. So I don't know if any of the other folks want to weigh in on that.
I will say I was speaking to someone in Singapore who follows India politics, and we agreed he would not come today. He will come next week. We'll form an India election reflection deep dive. And I take your point, Janan, on some of the other bits on Mexico. Sanjeev?
Yeah, same on the India thing. The follow-on question is, in terms of foreign direct investment and things like that, do you see any of that changing, Stephen, in terms of more or less coming into India, or rules changing of getting money out of India, which has been a concern for decades now.
Yeah, the problem is it's a Rothschild tell, right? You can put your money in, but you can't get it out, So it's kind of, how do you think about that? If it's great if you're a long-term investor, but I think that's one issue. I think the other issue is that their capital markets need a lot of development. It's not the most liquid capital market system. It's growing, but for the size of the country and the size of the economy, I think it needs to be more robust, and that takes time. So I think that you need a good healthy capital market system that has depth, and I think they need more work to do there. I don't know the total size of the bond market there, but it is. I think people would be shocked if they understood the total size and liquidity of that market from a fixed income perspective. And until you get that, it's hard to keep it going. Walter.
Walter?
Hi, Steve. Thanks once again for your presentation. And so last week I was in Mexico all week, and I was in Guadalajara, Monterrey, as well as Mexico City. And your comments on Mexico are spot on. The economy's strong, and AMLO has taken advantage of that strong economy to promote and distribute his social program. And I don't see much changing with this new candidate. The hope is that she will be a little bit different as a female. They're interested to see how that's going to turn out. A lot less aggressive in his power grab, because he did try a power grab. So that'll be interesting to see. Regarding the Chinese, though, the Chinese investments that are going into Mexico, they're not necessarily welcomed by the Mexican population as a whole. They see this as what it is, but the way the Chinese are doing it is they're not only just investing in Mexico, but they're actually bringing Chinese people into Mexico to run the factories. And I'm talking not just at the head of the management level, but they're running these factories with Chinese employees, and that's looked down on significantly. But that's what it is. Mexico, I think, is moving in the right direction, but much to be seen.
The other thing that makes Mexico a harder place to invest is, when the cartels have such a big sway over such large parts of the country. I worked with a manager back in the 80s, Stan Salvikson, who was the strategist for Merrill Lynch. And he used to say about Japan, he always had a hard time investing in a country that you were investing with the Yakuza. And I think in Mexico, you have that similar thing where the influence of the cartels is so great that it makes it harder to have the confidence to attract the capital that they need. So it's going to be an interesting dynamic to see how that plays out, because the violence there is high. So,
Walter, can you speak to the violence through your travels?
Number one topic on everybody's mind is the violence. Number one topic. Now, mind you, we were careful where we were. We were mostly in the tourist locations, good hotels. If you know where to go, and we were with Mexicans the whole time, so it wasn't much of an issue for us. But the violence that's taken place. Oh, the other thing that happened, there was a big protest. We were staying at the Sheraton in Mexico City, right next to the American Embassy, and there was a huge protest at the American Embassy. Made it really difficult to get in and out of the hotel. But that was because of the Palestinians and the Gaza war. So there's all sorts of stuff going on over there.
They lit the Israeli embassy on fire.
Did.
Joe?
Yeah, if I could offer a comment, I dated a lady from Mexico City for several months, and her family was very prominent, well known in Mexico City. Her great grandfather was the Secretary of State, grandfather Secretary of Agriculture, brother was an advisor to the President of Mexico in the 90s and ambassador to Spain and Portugal. So she was very well placed, and still has naturally family. She's here in Austin. So she's still got a good pipeline from that slice of Mexico City's sort of, her family's part of the sort of Mexico City nobility, if you will. And they're really, really worried. I mean, two of her cousins are migrated and are living here in Austin predominantly. They'll go back down there, but they're that at least, and it goes back to, according to her family, where the president of Mexico had maintained for the longest time basically détente with the cartels. And that détente basically gave the cartels not carte blanche, but the government and law enforcement would look the other way as long as they stayed on the periphery and outside of Mexico City. And when they had a reformist president come through, and I don't remember which one, but it was some time ago, I want to say in the late 90s or early aughts. And that person won based on taking on the cartels. And that destroyed the détente. And now they're doing, I mean, they've showed up in Mexico City in a extreme way. And then the murders of the politicians is just another example of the escalation. But they're now extorting shop owners in the best parts of Mexico City, which they stayed out of. And then the resort towns as well, they used to stay out of. And now we've heard about how they've taken over a lot of the resort towns and in fact are big owners of some of the biggest complexes getting built in some of the Tulums and Cancuns and that sort of stuff. So there was a general peace. And then when the reformist president came in a number of years ago, the cartel said, screw it. And now they're everywhere. That's her read from her family.
And Joe, on that, when they came up they started hitting the resort beaches, that was, I think, a big change in the tone for how people felt about that détente that they had, the killings in the resorts that you started to see the last couple of years change the dynamic considerably, I think.
Yeah, I think from an international standpoint, because of all the travelers and the resorts, yeah, it started, I don't know, 15 years ago. I can't remember. We talked about it. I looked it up a number of months ago, but yeah, when that détente ended, it was like all the rats just scattered now outside of where they were staying in the non-resort town periphery, mainly the U.S. border, and have just gone everywhere now. So,
Tim?
Hi. So what's the relationship between the cartels and all the new Chinese investment that's coming in?
Fentanyl? Is
I
it
didn't hear you.
fentanyl? Is it fentanyl? It's part of it. I think they're doing in Mexico what they do elsewhere. They're exporting their Belt and Road as best they can and try and move their export capabilities around the world. So that's their goal. And as I think somebody mentioned, or Wanda mentioned earlier, it's a way to get their products in through finished goods, because it's hard to track the finished goods part of it. That's how you beat some of the systems.
One comment that was made while I was there that's interesting is the Chinese are trying to do in Mexico what they have done in some of these other Latin American countries, where they just bully their way in, they bring in a bunch of money, they pay everybody off, and they get the certificates and environmental permits to operate. And that's not working so well for them in Mexico. So there's still some hope there, I'd say. So they've got a lot of money invested and they're not getting the operating licenses to actually run the factories.
Were they building soccer stadiums and stuff like that down there, like they're doing in the Caribbean to win the hearts and minds?
Oh, I didn't hear anything about that, Steve.
Yeah, they do that a lot in the Caribbean countries. They'll go and build a cricket stadium or a football stadium and whatever, and they'll start to do cultural things that get the people thinking these are great. It's great that they come, and then they bring their people in to take the jobs, and that's been the kind of the rub. So,
Well, this is also played up across Africa, but at least they're building the roads and building the stadiums. The U.S. just ceded the world to the Chinese. Other comments, questions?
Mark, I actually had one slide that I wanted to show that I forgot to show, and I usually don't do this, but Denzel Washington had a comment that kind of summed up the week for me, which is this. And I thought, boy, wouldn't that be nice?
Stephen, I used to read Stan Salvikson's writing. He was epic.
Yes.
Can you talk a little bit about Salvikson and how close you worked with him?
Actually, he sub-advised a fund when he was at Comstock Partners for Dreyfus. So I spent a couple of years working with him quite closely, and he and his team, Charlie Minter and Michael Arenstein, and brilliant, one of the most brilliant writers, financial writers around. But he saw the world very differently than most managers do. And in '87, I had the unique opportunity. Both he was sub-advising a fund for Dreyfus, and so is Stan Druckenmiller. So
Wow.
in 1987, both of them were up over 30% for the year.
Yep.
And
Yep.
they were the prettiest girls at the ball for some time after that. And he had a heart attack. He was not, he didn't take the best care of himself, had a heart attack and died very young. But one of the most brilliant thinkers around.
He was. I'll never forget it. I mean, he was absolutely brilliant, and he was a great writer too. The way he would find the turn of a phrase and to drive home a point. And he was a brilliant investor,
Yes.
as you point out. But his writings were just epic.
He got the gold bug shortly after in 87, 88, and it was the wrong time, and that actually hurt him quite a bit from his reputation. But brilliance throughout. One of the great minds that was lost way too early.
Stephen and Joe, can you just cut paste the name of the book that I should read in this context of the person you're talking about?
Well, actually, it was more. He did more of research writings than books. So I don't have one for you on him that I'm aware of. For you, Joe?
Yeah, no, I don't have I never found a book. I got his writings, and whether they were I can't remember 2 or 3 a week or once a week. I don't remember, but I just remember they were. It was must reading back in the '80s when I was on the sell side, and then I continued to follow him when I went to the buy side in '90. But no, he was. I don't know. You could probably find it on Google. Just Google search Stan Salvikson. Suspect you might be able to find some of his writings. They were brilliant.
Find it under Merrill Lynch strategist, chief strategist, or under Comstock Partners.
Comstock is who I remembered. Yeah. Yeah. When he left Merrill and went to Comstock is I think when I started following him.
Yep.
Thank you.
You're welcome.
Other comments, questions, suggestions? I just put on the screen to remind everybody what's coming up. Tomorrow's meetup will be followed by AI legal tech. If anybody's interested in anybody involved in legal tech, welcome. Interesting. I like to add to the panel. I like to substitute myself off that panel. So there's that. And then on Thursday lunch, literally here at L'Adresse, next week, London. And then we're back to Newport, London, and in October, New York. You'll see that we moved back a November event from Riyadh to February. And we will be back in London for a big event in November with Armin Sarkisian again. So those are, and then if you haven't seen these Stanford recordings, highly recommend. Some of the best content we've had at 361, both on AI, semiconductors, and actually, and Joe, there was a secondaries panel, and fascinating. Ken Goldman wasn't even on the panel, but I think he spoke more than half as much as the panelists. But it was Anurag Chandra put together an excellent panel, and all of those you can see on the YouTube channel. There's a playlist of all the playlists.
I'll chase it down. I don't know.
Here it is. You can see the secondary markets panel.
I'm going to watch it. Henry Ward of Cardiff put out a piece this morning. I don't know if you saw it or anybody saw it about secondaries. It doesn't work. And it was his doing a mea culpa on their screw up from last fall, if you recall, where their own salespeople were contacting the investors, shareholders of some of their customers. So their cap table management tool, their own salespeople went and contacted some of the shareholders of some of the companies to see if they wanted to offer their shares as a. It killed Carter's brand, in my opinion. So he wrote a piece as a says it can't be done. I spent $150 million and it can't be fixed. And I'm gonna comment on it this morning after we get off this, but it was it was a really interesting commentary. Let me say he's trying to resuscitate history and their brand as a result, because it was borderline criminal activity in the secondaries market. They were trying to build a secondaries capability and they screwed it up because it's the classic ask for forgiveness versus permission mentality of Silicon Valley.
I think one of the themes was, first of all, 10 years ago, it was like no one really wanted to talk about secondaries. If anybody wanted to sell, you were selling out. You know, you stick with the boat. And then in today's capital markets, you know, you're trying to provide somebody said, I want to find out what exactly it costs you to buy a house, and I'll give you that and no more. But a lot of it is being done behind the scenes and off the cap table, and they thought maybe. Anyways, it was an interesting discussion, and then, but clearly for investors to get access, it's an interesting way to do it. But if you're not on the cap table, you could lack information, and sometimes the ability to trade on that information in a round or a down round or whatever. So it was a good debate, good discussion. You can see it on that. I think we should probably do another one wider than just Silicon Valley.
Was there any commentary on there? Again, I'm going to watch it on secondaries through more of a ETF-like structure, or technically it'll be a closed-end trust under the 40 Act, as opposed to individual transactions? Because to me, that's the ultimate answer, is trying to do it at the individual transaction level is a Herculean task. But when you can standardize around a pool, you don't have to worry about how mispriced the 409A is on any of the individual holdings. It sort of all comes out in the wash through the portfolio effect. Was that touched on?
Does anyone remember that?
No, I actually like that line of thinking, Joe. I want to follow up. I'm new to all this, so I'll follow up with that.
Yeah, I mean, that's the lessons in the public markets are clear. I mean, there is a way to do it. Ward is wrong at multiple levels, and like I said, I just think he's well. I don't want to offer my recorded opinion to that guy, but or Carter for that matter. But there is a path. There's no doubt about it. And the beauty of the asset class is that if you're right in your allocation, you'll make up for the minutia of mispriced individual holdings from a 409A valuation standpoint, because there needs to be a standardized evaluation mechanism, and it's never going to be perfect, like a bid and ask in a publicly traded security. But the closed-end trust or ETF model will capture enough of the asymmetric upside to make up for any mispricing at an individual holding level, and so you can have liquidity and still participate if you're staying long. That's where it's going to end up.
Is there any formality to that? Is there is that well accepted in the industry, Joe? What you said?
Well, yeah, that's a big. There's a battle going on between the folks from the public markets that are familiar with everything I just said versus the venture industry, which is largely unfamiliar with everything I said, because they still think at a transactional individual approach. And that's where the inertia is those two coming together. But we're already seeing 40 Act wrappers around late stage PE and late stage venture coming from the Vanguards and Wellingtons of the world. So it's already moving from the big platforms. And I guarantee you BlackRock is moving this direction. There's Wisdom Tree that just does ETFs moving this direction. So there's a ton of the public market participants that are familiar with 40 Act wrappers moving in this direction. Yeah.
Anyone see the Vinod Khosla interview by Sam Altman?
The one where it said most VCs don't add value, that one?
Well, not most, it was, like 90%. And he
Yep.
thought 70%, detract value.
I couldn't agree more. I couldn't agree more. I couldn't agree more.
But
Then-
at the same time, family offices are not equipped. Typically, you know, they don't have teams, they don't have processes, either. But it's an opportunity for some of them that if you could find the right marriage.
I still think that's a false flag. I personally, I think the investment world and family offices in particular should invest in a portfolio approach and not
Right,
even think you can add
but
value.
they don't.
They'll put out a false narrative.
Well, again, it's those with domain expertise that can stick to their knitting, that understand what they're doing, but then they get distracted by the shiny objects, and
Exactly.
you don't have a portfolio of any size. I think it was you, Todd, Rupert, and others. You know, we're talking about hundreds. You know, not like 12.
Right. But there are 100 of individual transactions versus a portfolio theory and portfolio approach. And again,
Correct.
just because you got 100 doesn't make it a good portfolio, you know, garbage in, garbage out sort of thing. So no, I really do think it's where it has to go. Because the lessons, if you just look backwards at the lessons learned, dedicated full-time VC firms purportedly don't add value and 70% detract. And I think he order of magnitude's accurate, I think. Whether he's statistically right on the spot doesn't matter. The order of magnitude is what's important. And so those are lessons learned. And so don't try is the answer to me, because that's really presumptuous to think you can add value when 90% don't, or some equivalent of 90%.
I thought
Been well trodden.
the most important message I heard was, he was also talking about the younger people asking to be on boards. Like, you don't deserve to be on a board.
Exactly.
Have you been an entrepreneur? Have you suffered the slings and arrows of what that means? Are you really supporting these entrepreneurs? Or are you just supervising them?
Or it's just ego. And at the end of the day, if you look at Danny Kahneman's work, Mr. Moneyball, that's the exact wrong thing to do if you want to maintain objectivity. You get captured by the story of which you are on the board of. And so you have a vested interest in the outcome versus if you're a GP of a fund that's invested in a company and you're on the board, now your ego is associated with the outcome and you've lost objectivity if there's follow-on investment decisions to be made.
Well,
I mean, it's just structurally flawed.
but
Michael
also, one, being on the board creates a fiduciary obligation for you. So I know investors who absolutely will not be on a board because of that.
Exactly.
And then the other issue is when we talk about younger people being on the board are supposed to be the adults in the room.
And there aren't many in Ventureland. There aren't many adults in Ventureland. You're exactly right, Michael. I mean, it's because a GP of a fund, their fiduciary responsibility is to the investors, not to the entrepreneurs. Don't lose sight of who your customer is and where your actual fiduciary responsibility. And you're literally diluting that if you get on the board. And those horror stories are constant. And that is a structural flaw in the old venture model itself, because they approach these things as transactions versus being a fiduciary-led portfolio manager approach to allocating their investors' capital and manage all risks appropriately. And decision-making or decision process risk, the Moneyball sort of philosophy, is a critical one. Is a critical one to manage. And you literally can't if you're on the board, because by definition, you've lost objectivity.
Joe, there's another element that a lot of the managers have only managed in zero interest rate environments until the last year if they've had 15 years or less of experience.
Exactly. Yeah, the experience they have is distorted. Absolutely. And that's across all asset classes. It's not just venture.
No, it's everywhere, but that's a factor to the experience question. It's they've never experienced a real sharp rise in rates and what the impact is.
We have a professional board member, Wanda, is about to,
Just very quick comment to Michael's statement about the adults in the room, which is very true, but the room changed significantly with AI, cybersecurity. So I think we need to find a balance between adults in the room and those who understand this new environment and new customers. And politics is not my strong point, but I really would welcome a different age makeup in the Senate. So our policymakers will understand certain elements of digital economy and digital consumers. So yes, the supervisory role of the board is important, but so is the strategy. And we need to have adults who can foresee the strategy moving forward in digital economy. Thank you.
I guess I'll go next. My hot take on this topic is that I know we were talking about adults in the room and all that, and I generally tend to agree on that, and I agree with Wanda's point as well. But I have a slightly different take on people who write checks don't necessarily understand the business or the domain better, and they're given too much of a voice in the boardroom. They just don't know enough, and that is never that tension always exists because the check writer needs to be respected because it's their money, but they don't understand necessarily that you can't just have the same revenue per employee because a peer company has has the same revenue per employee. So these are different businesses. Anyway, that's my hot take on that.
yep. Michael?
So I just wanted to respond to Wanda's comments. Cybersecurity, things like that, that's domain expertise. That's not about whether folks are the adults in the room or not. The way I look at it, when I say adults in the room, I had one investment a few years ago where the founder came back to a group of the investors. They only had 6 weeks of runway left. And I knew several of the board members, and I reamed them out because this was a first-time founder, but they should have had their eye on the ball and saying, wait a second, you're running out of money, and it shouldn't have gotten to that point. That's what I mean by adults in the room.
Yeah, I agree with that. I guess I've been sitting on enough boardroom discussions about the strategy where the distinguished adults in the room who should know about the runway and the cash flow really could not grab the essence of the changes, and were simply confusing the strategy conversation. So yes, this is the subject matter issue, and the adults in the room have the responsibility to bring themselves up to the speed. Not all of them do. And I'd be delighted to continue this conversation offline. I don't want to dominate that.
Wanda, anytime.
Okay, you are on, Michael.
Cybersecurity is near and dear to my heart, as Mark knows.
Okay.
You'll even miss our events to go to a cybersecurity conference.
Only if I'm on the program committee.
Yeah. Any other comments before we break?
I'm putting a report in on the chat box. There was a fabulous report came out in 2020 called The Future of Venture Capital. And it talks about a lot of the things we've talked about here. And this was a study done by an independent consulting firm, Clayton Christensen's firm, Mr. Disruptive Innovation. And they were hired to study the venture industry and came up with these observations and then projections about the direction of its movement. And it's consistent with what we've been talking about. So I'll post it in the chat box.
Mark, I do have one that next Tuesday, we're going to be hosting a call with Dr. Ed Yardeni. He's going to share his thoughts on the global economy. I think he has a call for Dow 60,000 by 2030, and is one of the more positive voices on where we're going and as in the markets and the economy. It'll be a fascinating conversation. So Mark, I'll get it in the chat. And
I follow him, but I didn't see that quote, the 2030, 60,000.
yeah, that was a couple last week or
Okay.